Let's talk markets now. Gary Dugan's with us in the studio. Morning, Gary.
Good morning.
New year, new job, Chief Investment Officer, Emirates NBD.
Indeed.
Once again, congratulations on that.
Thank you.
Let's start with China. GDP numbers out yesterday morning. How good or bad is the situation in China, Gary?
No easy answer to that one. It's bad in terms of investor sentiment. It's not so bad in terms of the economic environment. I mean, I think if you look at the aggregate data over the last few months, it's actually come in aggregate, I stress, ahead of expectations, where else around the world numbers are coming below. It's just that the sentiment is so heavily weighted against this economy at the moment. The financial markets are in free fall, and it's very difficult for that situation to be turned around.
Malcolm and I were chatting earlier, or mainly Malcolm, talking about suspicions over the veracity of Chinese GDP data. I think that was Malcolm's phrase. The government has predicted 7% GDP growth, and miraculously the Chinese economy, or 1.5 billion people of it, is growing around about 7% a year. How do you approach this?
Well, I think one easy way to say is if the adjustment's the same every year, you just take 2 points off and you just look at the net number. Let's be fair, though. I mean, does China really need to grow at 7%? Not really. If you look around the world today, global growth's between 2 and 3. So any number better than that is a net contribution to global growth, and it still remains, one of the fastest growing economies in the world. But I agree, the number's probably not 7, and it's possibly a number close to 5.
What about oil? I guess last time you and I spoke, it was $45-ish a barrel, and that was bad enough. Today it's 28. How does that impact your world and the world of your clients?
It's that second or third factor that everyone's worried about at the moment that we want to see stabilization in. It's very difficult to say what the clearing price for oil should be. But I think, again, a bit like the China situation, people are exaggerating sentiment to the downside. We've clearly got a supply problem, but let's not forget, every year the world is growing and demand is also growing. When these two numbers of the oversupply meet an increasing demand, we're not too sure. So I'm not so sure that for the longer term a clearing price for oil is below $30. I think we're set to move up towards 40 and on to 50 over the next 2 years.
So in terms of our portfolios and our investments, let's start with local markets. It had a nice little bounce yesterday, shares in Dubai up 3.5%. Is it a buying opportunity yet in the UAE, in Saudi, given the recent declines in stock markets?
If you had no exposure, it is a buying opportunity. I think we're getting down to valuations that are attractive. There are companies there that if you even took a very profound negative view of the next few years, you could still make a value argument for buying them. But if you are already invested, I'd say just leave your money to one side for the moment and wait for a complete capitulation. Volumes have been light. It doesn't look like people have been forced to sell, and therefore we're not quite at rock bottom.
Elsewhere, the United States. You say you have some concerns about the United States. Tell us why.
Well, people will look at some of the data and say everything's okay. That employment report from about 10 days ago looked good because the economy created a lot of jobs. But those jobs, we believe, are fairly low quality or are not well paid. Secondly, we had a disastrous New York Fed area industrial confidence number on Friday. It was the worst since 2009. So this does not feel like the vibrant economy that the Fed talks about, and therefore I'd be surprised if they continue to push ahead with rate increases.
Well, on rate increases, we heard from Frank Kane at the National earlier. He's in Davos. Janet Yellen's not there, and he was saying it's just as well because she'd be persona non grata, because the word around the campfire in the evenings is that the Fed rate increase at the back end of last year was a disaster and has precipitated the turmoil in markets. And I know from memory 3 or 4 months ago you were arguing very much against a Fed rate rise.
That's right. I think it was just a confidence trick. I think they just wanted to talk the markets up. I think some of their economic models, which are probably broken, gave them a signal that they needed to be doing something. But as we've seen, as we've turned into this year, there's a soft underbelly still, even to the biggest economy in the world, and therefore significant further increase in interest rates as the Fed is setting out does not look appropriate.
So what's going to happen with interest rates? I mean, you ask 4 different forecasters, you get 5 different answers. Some people say one and done, that was it, they've done. Others are expecting 3 or 4 further rate increases in 2015. What's your view?
Yeah, my job is to look at where the market is and kind of say, is it right or wrong? And the market at the moment is pricing maybe, we'll call it 1.5 increase in interest rates. There's no conviction about it. The Fed is saying 4, but the building majority is saying no further rate increase. And I must say, just given, I say, the window of the last few weeks of the data we've received, the Fed should not be increasing interest rates anytime soon.
And in terms of our investment portfolios, what are we buying at the moment in these turbulent times?
We're telling clients to stay very safe with their cash. That means cash. I still believe that gold at this level is attractive, even though it's had a tiny run up. And we say short duration debt. So that's debt with only 1 or 2 years to run, which means that you're pretty certain you're going to get your money back. And in the meantime, you get paid 1 to 3% of taking a little bit of risk. But it's not time to be loading up with risk assets this time. You've just got to be still there with carefully and caution.
I mean, that is a very, very cautious risk-off approach to investing at the moment, isn't it?
It is, but so the worry is that we look at some of the technicals, which tend to be driving market sentiment at the moment, and you could persuade yourself that maybe equity markets fall a further 10 to 15%. Now, you may rebound quickly from there, but this is the world with no inflation, limited growth, and still limited opportunity to surprise us to the upside.
Gary, great talking to you. Appreciate you joining us today. Look forward to having you back again soon. Gary Dougan, Chief Investment Officer at Emirates NBD.